Welcome to GRE. I'm your host, Keith Weinhold. The risk of delayed gratification is denied gratification. There's a new wave of landlords. Wages are rising faster than both inflation and home prices. Learn what that's going to mean for rents. Hear the voices of 5 different Federal Reserve chairs. Then GRE announces our biggest event of the year, and you're invited today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
Mid-South homebuyers with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100,000 to $150,000. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From the Adriatic Sea to the Atlantic Ocean and across 188 nations worldwide, I'm Keith Weinhold, and this is Get Rich Education. Sometimes we all need a mindset reset, and this can include me sometimes. James Clear, the author of Atomic Habits, says there are 4 types of wealth: financial wealth, which is money; social wealth, which is status; time wealth, which is freedom; and physical wealth, which is health. Be wary of jobs that seduce you with 1 and 2, but rob you of 3 and 4. That is to say, be careful with jobs that seduce you with financial and social wealth, but rob you of time and physical wealth. That is definitely going to happen to you during your life, especially early in your working career. But many people, even most people, they don't do much about this. They just go on, selling their soul to their employer for decades. Sometimes paychecks aren't compensation. They're a bribe from an employer to give up your dreams. Early in your career, delayed gratification actually makes some sense because you need capital formation, you need down payments, you need dry powder. That is totally fair and the time in your life for delayed gratification. But there's a point that most people miss. The point where delayed gratification quietly mutates into denied gratification. This is huge. Most people miss this inflection point. When is this point in your life? That's when I'll do it later becomes, well, I guess I never did it at all. They look up at what they've got at age 65 and realize that they have a respectable title, they still wear Dockers pants, they have a 401k that they must start paying tax on, and knees that creak louder than the front door. Compound interest hardly outpaces taxes and inflation. That's just going to keep you in one spot, and you're never going to get that time back. There is no do-over there. So you need to get to the point where you can be more frugal with your time than your money. Younger people have a harder time adopting this mindset, and that's a little natural because they have more time and less money. Sooner than later, you must desperately get financially free so that you can simply be yourself. Workaholics optimize income instead of assets, and you can't let that happen because labor does not compound and capital does compound. Your quality of life will exceed your cost of living when your life is funded by what you own, not by what you do. That takes a different mindset. You can either be a conformer or you can build wealth. When you invest in real estate that pays 5 ways, it's like what you're doing is buying future Tuesdays where you never have to work again. And then later add on future Wednesdays where you never have to work again because you got the compound leverage instead of the impotent compound interest. I mean, just consider your $2.5 million portfolio. That is passively doing the same work as someone who sells 40 to 50 hours a week of their life away for $100K in yearly salary. Well, all right, maybe you're thinking, oh, that all sounds thought-provoking, but if you're not engaged on that, it can sound airy and philosophical and even risky. It's sort of like, you're cueing the acoustic guitar music and slow motion images of someone pensively gazing at a sunset. All right, what is the concrete plan? It's not all about mindset. It only starts with mindset. You got to make that actionable. Well, we constantly provide concrete plans for you here on this show, and I've got another concrete plan for you toward the end of the show today. This harkens back to what I discussed with you 7 weeks ago, 7 episodes ago on the show. That's when I discussed the world's first billionaire, John D. Rockefeller, and his enduring quote from about 100 years ago, "He who works all day has no time to make money." Yeah, that's the quote. A little review. What you learned 7 episodes ago is that Rockefeller meant if you spend your life doing tasks, you're never going to rise high enough to own things that pay you for life. The bottom line here is that earning a living is a distinctly different activity than building wealth. That's what we're talking about here. Well, there is a new wave of landlords entering the market, and they are reshaping what owning rentals looks like. One survey by rental platform Avail of nearly 2,000 users, it's really influential. It found that 53% of landlords became landlords in the last 5 years. So you have a lot of new landlords, with the most 17% of landlords entering the market in just the last year. Most purchased a property specifically to rent it out, and 1/3 sort of backed into this business by renting out their former residence. Well, of course, some people want to rent out their former residence today if they got locked into that sexy owner-occupied 3% and 4% financing from 2022 and earlier. The survey went on to tell us with some really good takeaways here. 72% of landlords manage between 1 and 4 units. And this Avail survey, it's just another one that shows that the majority of landlords operate small portfolios. Classic mom and pop investors. That one's not too surprising. The top 3 reasons that landlords gave for entering the rental market, they're pretty interesting. The number 1 reason for getting into this, at 41% of respondents, is building long-term wealth. Next, 33% for generating passive income. And the third most popular one, it's a distant third, it is preparing for retirement at 13%. So building long-term wealth is the number one reason for getting into this, and that is the right reason. When it comes to ownership structure, 64% said that they own the property individually, whether that's through a single-member LLC or in their own name, doing it, individually rather than with a family member or a business partner. So really, the summary of this terrific recent Avail Landlord survey is that if you're just getting started, you're not alone. A lot of people are. Most own properties solely in their own name, and the number one reason for doing it is to build long-term wealth. Now, there's another pervasive set of economic trends out there in the broader economy, but it's really a benefit for real estate investors, and that is the fact that wage growth has now outpaced consumer price growth for 3 years. Another way to say that is that wage growth has outpaced inflation for fully 3 years. Most people just aren't feeling it yet. So you might be taken somewhat aback by that. And why aren't people feeling that wage growth is faster than inflation? The pandemic inflation spike, that was so huge, it was like getting hit with a freight train, and then someone tells you, good news, the train has stopped. Yeah, that's nice. You are still lying on the tracks rubbing your ribs. That's because we're all still absorbing spiked prices for everything from a lumber 2x4 to a York peppermint patty. Year over year, wages are up 3.8% and consumer inflation is 3%. All right, so wages above inflation, that means things are getting a little more affordable, but both wages and inflation have grown faster than home prices, which have only grown about 1.5%. And this is all per the BLS and the FHFA. So wage growth being more than double home price growth, well, that trend really makes properties more affordable, but historically they're still not that affordable. Everybody knows that home prices soared until about 2023. That was the turning point, and now wages are in their catch-up phase. All right, but what really matters to real estate investors is when will this wage growth translate to rent growth? Historically, big rent growth, that lags big home price growth by about 2 to 4 years. So you have the big home price growth, big rent growth hits 2 to 4 years later historically. Now, if that holds true, we should finally see substantial rent growth this year or next year. Rent growth has still been pretty soft in the 1 to 4 unit space, and even there are rent decreases in the overbuilt apartment space. Future income growth promises to make homes more affordable. Affordability has already improved with mortgage rates hovering near 3-year lows. There's one problem, though, that most people overlook, and that is this. Wage growth has been skewed toward the higher income deciles. Renters, especially workforce renters, they don't feel it until later. So this 3.8% wage growth, it's heavier for higher income people, and it's lighter for lower income people. I swear, when there are enriching economic trends, it always hits the higher income people first, and it doesn't trickle down until later. So if you as an investor are positioned before the rent wave hits, you are surfing, and if you wait to feel it, you're swimming behind the boat. Higher wages should translate to higher rents in the next 1 to 2 years. And as far as some other forces, as we all know, the man occupying the Oval Office in the White House, the president, he wants lower rates. The current Fed chair isn't so willing to do that. The next one, the one he appointed, Kevin Warsh, who arrives in May, he seems more receptive to lower rates, but it's going to take a while. It all moves so slow. We have had 16 Fed chairs before Warsh over 112 years. And look, how much of an econ nerd are you? Are you as bad as me? These voices are in chronological order, and I can name each speaker.
You're going to have to live with the fact that Forecasts have a range of uncertainty.
Irrational exuberance.
In my opening remarks, I'd like to briefly first review today's policy decision.
But first, I'll review recent economic developments in the outlook.
And we are well positioned to wait to see how the economy evolves.
If you can name each of those speakers, I would love to give you a free property from GREmarketplace.com, but I can't quite swing that. In order, those voices are Paul Volcker. He served from 1979 to 87. He was known for crushing double-digit inflation by jacking rates to near 20%. It was painful medicine, but it worked. The next one, Alan Greenspan, served from 1987 to 2006. That was a long reign, almost 20 years. He oversaw the 90s economic boom, the dot-com bubble, and the early housing bubble years. So far, Greenspan is the only Fed chair that I have met in person. Then Ben Bernanke, he was the Fed chair from 2006 to 2014. He took the helm right before the 2008 financial crisis. He rolled out QE and emergency lending on an historic scale. In fact, he was nicknamed Helicopter Ben because it's like he would print so much money that he just dropped it out of huge sacks, dollar bills in huge sacks, dropping them from an airplane, metaphorically, not literally. Then Janet Yellen, 2014 to 2018, she kind of continued this post-crisis normalization, and she was the first woman to chair the Fed. And then, of course, Jerome Powell, serving from 2018 to 2026. He navigated the COVID stimulus, ultra-low rates, and then after that, the fastest rate hiking cycle in decades to fight inflation back in 2022. Being the Fed chair is the most important job in this economy, and over the decades, there's been more of a movement of the Fed into the public eye. You just hear about them more in the media than you used to. But like I touched on last week, it just still doesn't mean as much to real estate investors as a lot of people think. People sometimes look for someone else to come save them, but it's more about you and the choices that you make. That's what means more. Housing supply and demand means more. Real estate investors have profited during every one of those Fed chair reigns, which go back almost 50 years from Volcker to today. I think everybody knows that Fed chairs don't control property prices, and they don't even control long-term interest rates. What's a little paradoxical is that Trump has been vocal about how he wants more affordable home prices, yet at the same time he wants existing homeowners to have their home prices go up. Those two things seem to be in tension. They're in conflict with each other. The only way you can possibly get both are through lower mortgage rates. But as you're going to see later today, you as a GRE follower, you don't have to wait for lower rates. Income property still feels less affordable than it did 5 years ago because it is. That's real. But here's the key distinction and what makes real estate investors different from owner-occupied homeowners. Affordability isn't about the price of the property. It's about whether the property pays for itself and grows your net worth while inflation does the heavy lifting. Higher prices don't kill investors. Inaction during inflation does. You're not buying a, say, $350,000 property. You're controlling it with $70,000 while your tenant and inflation do the rest. We do not rely on hope or appreciation. We start with income, tax benefits, and debt paydown, and then leverage appreciation typically happens as well. GRE only succeeds when investors close on properties that perform long-term. One bad referral costs us years of trust, so we don't do that. The best question for you really isn't whether property is affordable. The question is whether owning an investment property is better than inflation compounding against you. That's the investor lens today. Coming up next week on the show here, we're going to discuss apartments. It's been a truly beleaguered sector where their prices have fallen 20, 30, and 40% in many markets. We've discussed apartments here on the show a lot before, like with Grant Cardone on episode 264. with Ken McElroy countless times, with me monologuing about apartments. And next week, we're going to talk to a multifamily educator who is known as the Apartment King. Later, on a future show, we've got the return of the financial firebrand, and lately, the financial comedian, Garrett Gunderson, a powerful speaker. That's definitely going to be interesting. As for today, you'll hear a first-person account from a Florida resident about why he's moved to Florida and why he invests there. You've heard of this guy before. That's next. I'm Keith Weinhold. You're listening to episode 593 of Get Rich Education. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom Coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Rent to Retirement's Zach Leemaster. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
I'd like to welcome in our own in-house GRE Investment Coach. We haven't had you on the show since November. Welcome in, Naresh.
Keith, it's a pleasure to be back on the show. Thanks for having me on.
Now we're just playing it all casual and comfortable here in-house. You were just finishing up, ice cream or a container of something right before we got started here?
All done with the ice cream and ready to record the podcast.
Yeah, all right. Keeping cool for our chat. Well, you do live in Florida, so you must have your own perspective on the Florida market. You live in the Tampa area, and the reason that that's a germane topic is that's something we've been talking about here lately as really an opportunity, and that is because most of Florida has seen some temporary property price attrition, but yet more population growth is projected. So that's why we feel like that's temporary. But why don't you tell us about what you see on the ground there?
Keith, I've lived in Florida for 11 and a half years now. That's Tampa, Florida. I like Florida a lot. I moved here December 2014 for similar reasons that many people are moving here today. So I moved to Florida in December 2014 because of no state income tax, because of, at the time, lower cost of living. Florida was one of the states that got hit the hardest during the 2008 financial crisis, or I think called it a real estate crisis. Florida, Arizona, those few others got hit really, really hard. So Florida at that time was still rebounding from 2008. So I moved for the affordability, the no income tax, of course, the weather, better weather than most places in the Northeast I've lived. So weather is a big deal when it comes to real estate and geography as well. These are all different reasons to move to Florida. And these are the reasons why I moved to Florida. I was also single in my 20s. So I was much younger at the time. I was single in my mid 20s. And Florida is very good for that too. For 20-something Gen Z folks today, Florida is definitely a place that they should consider. I moved down here and I fell in love with it from day one. I got a place living right on the water, a beach, got beaches everywhere. Florida is Florida. And I say all this because these are all enticing features of Florida for renters, for tenants, for snowbirds. I had never even heard of what a snowbird was until I moved down to Florida, where you have people who literally live here for 7 months of the year, and then they live in their home state for 5 months of the year. So that's generally what it is, 7 months in Florida, 5 months in their home state, which can be, the people I know personally are from New York, Connecticut, Illinois, Ohio. The list goes on and on. Basically anywhere that's north of Florida could be considered a snowbird area. So that's another reason why Florida is a very hot market. Now, obviously during the pandemic, in end of 2020, people started moving to Florida in droves. Part of it was politically because you didn't have the restrictions that other states had during that crazy time that we lived through. And another part of it was work from home. So similar to me in 2014, when I became full-time work from home, I wanted to move somewhere for all those different reasons that I gave you, the total package. And Florida fit that. There was maybe one other state that fit the bill based on everything that I told you. Probably one other state, that's it. So Florida fit the bill, and that's why I think Florida is always going to be, despite the hurricane threat, Florida is always going to be a destination that people will seriously look at. Whether you're older, retirement age, or younger, like I said, in my mid-20s, single guy, Florida is always going to be that destination for all the reasons that I laid out. So with that being said, what does that mean for real estate? What that means for real estate is that there's going to be a constant supply of people coming into Florida. And when there's a constant supply of people coming into Florida, then you can expect real estate prices to at least not decline. We passed, all sorts of bills, including Dodd-Frank post 2008, to prevent people from taking out mortgages that they couldn't afford. So now that that's out of the way, when you have a constant supply of people who are able to afford homes, who are able to afford rents, well, that's going to be a constant supply. So that's good for investors. That's good for appreciation. It's good for cash flow. And that's why I'm a huge fan, not just of the state of Florida, but also investing in Florida. And I own real estate in Florida. And you can say that I lucked out, but I bought a property in 2019 and it nearly doubled in value.
Yeah.
When I say doubled in value, in a matter of, I want to say like 2 years, 2.5 years, it nearly doubled in value. So with that being said, Florida, this was a rare cyclical trend when we just saw this huge upswing. Rare cyclical trend, but I don't anticipate cycles like this where you're going to have booms and busts moving forward. We haven't seen a bust since 2008. Like I said, the law has been taken care of in that sense, the regulation. I love the state. I've lived in 6 major cities, but maybe 5 different states. And Florida is hands down my favorite. That's why I've lived here for, 11 and a half or 12 and a half years. I don't even remember anymore. It's actually 11 and a half. My roots are here. I now consider myself a Florida person, even more so than the state of Texas, which is where I spent 18 years. I have no doubt that I'll surpass 18 or 19 years in Florida and that this is it right here. And a major reason is because this is just such a great state. It's free. It's real estate friendly. This is for people who are looking at buying primary residences, not for investment properties. But the governor has put on the ballot this coming election cycle to abolish the property tax in the state of Florida. So if you live full-time, not a snowbird, not investors, but if you live in Florida permanently, then no more property tax if the vote passes. So that's another huge plus for owning property if you're a permanent resident in Florida.
Yeah, even if the property tax is abolished, which seems unlikely, you could just tell what the tenor and the temperature of the tax climate and the investing climate is like in Florida if they're even spearheading such a proposal and they're a national leader in something like property tax abolition like they are. And Naresh, about 8 years after you moved there, which would be, about 2020, 2022, somewhere in there, we had that strong pandemic migration push into Florida. But what's happened is that flow has slowed down. There's still positive net in-migration in there in Florida, but the builders, they got ahead of this, and the pandemic migration wave waned, and they had a temporarily overbuilt condition, and they still do now, which is one reason why we've seen prices fall somewhat in most Florida zip codes. And this spells part of the opportunity. So you do have all these new build properties, some of which are vacant, but you have a good chance they're going to get absorbed pretty soon. And there are some obvious advantages to owning new build.
Well, Keith, there is brand new construction in Florida. Like you said, the work started in 2021, and there are homes that have not been sold. I don't want to say since they were finished building in 2021. They recently finished building in 2025. And these homes could be a variety of reasons. It could be economic related. It could be hurricane related. In Tampa, the Central Florida, we had 2 horrible hurricanes back to back within a 15-day period. 2 really bad hurricanes towards the end of 2024, September and October 2024. And people lost their homes. Renters lost their homes. Other people just were freaked out and scared and said, you know what, I don't want to deal with it. I've got PTSD from these hurricanes. I'm moving up to Alabama or Georgia or Orlando, somewhere in Central Florida that's away. But even that area, the hurricanes still made it through to those areas too.
Still in effect.
People just picked up and said, you know what, I'm done with Florida. It's a great state, but I don't want to deal with these hurricanes. And so regardless, whatever the reason, this is a pie and these are all slices of the pie. I don't know what's been more of a contributing factor than which one has been more than the others. But with that being said, there are tons of properties in Florida, pretty much the entire state of Florida, where especially new construction properties are below, at the time when they were being built, they're below what they anticipated being listed as. And so, Keith, we're having a special webinar this Thursday talking about these properties because they are discounted properties. They are properties that are selling at tremendous discounts, like I said, to when ground was broken years ago. So join that webinar, grewebinars.com, grewebinars.com. Again, brand new construction. Many of these properties already have tenants in place. Not all of them, but many of them do already have tenants in place. There are all sorts of incentives that the builder is offering. And there are many builders in that, not just this one that's going to be on the webinar, but in Florida, there are many builders who are offering discounts, rate buy downs, other incentives, because the home values have fallen somewhat a bit. Why have the home values fallen? Because the demand has fallen as well. So again, the next question people might have is, well, if the demand is falling, if home values are falling, why would I buy? The trend is downward. And the answer is, whether it's a stock or any other security, you don't necessarily want to have the FOMO to buy at an all-time high just because everyone else is buying it. And I actually have family members who bought real estate at the peak of 2022. There was FOMO and there was, hey, I need to get a flip. And they're down. They bought peak 2022 and they're down today. Because look, you can pick any housing market in the country, especially a prime state like Florida. Look at any 30-year period and you will see that home values are up double digits. Even if you look at 2009, when the housing market crashed and we reached something like 10-year bottom in housing. If you look at the 30-year period, well, if someone who bought a house in Florida in, say, 1979 was still way up on their property in 2009, 30 years later. We're not buying Bitcoin here, where it can go up 30% in one day or go down 30% in one day. We're talking real estate, and real estate has been proven. It's been tested. It's been proven throughout time. Not even a 30-year period. I think if you take any 20-year period, you're going to see the same trend of double-digit gains, double-digit growth on real estate appreciation. So I'd say if you're skeptical about Florida, you see these home values, all these discounts, that's the first thing I hear from followers. They say, why are they offering so many discounts? I'm a little concerned about all these discounts and incentives, and I don't know if that's a good thing. Well, I say, well, I mean, you can buy full price in another state if you'd like, in California, so you're more than free to buy full price, but we're talking Florida here. We're not talking about West Virginia or Rhode Island or, Nebraska. We're talking Florida. This is still the land of Mickey Mouse and Minnie Mouse. This is the land of the best beaches in the country. I mean, there's just no arguing or debating these facts. Florida, all the reasons that I stated earlier, is going to continue to be a hot market. So I highly recommend people, if you want to get in on these discounted deals, grewebinars.com, grewebinars.com. Register for our upcoming online and live special event this Thursday evening at 8 p.m. Eastern Time. 8 p.m. Eastern Time, grewebinars.com. You won't want to miss this free online and live special event.
When a pound of oranges is on sale or a pound of zucchini is on sale, consumers are often attracted to that sale. It should probably be the same way with you considering adding to your real estate portfolio. And it's funny, when oranges or zucchinis are on sale, no one tries to find fault with it and think that they're rotten inside or something like that. But somehow with real estate or an investment, that tends to get scrutiny from people. But these are real discounts that you're getting over buying, say, 2 years ago. And we're talking about a motivated seller here. And as you know, Naresh, we had the builder on the show last week, the one that's going to be co-hosting the webinar with you on Thursday. And he talked to us about buying down mortgage rates to between 3.75% and 4.25%. And we're here at a time where the owner-occupied rate is 6 to 6.25. The investor rate is 7. So you're getting about a 3 percentage point buy down. That's really the attraction. And Naresh, before I ask you if you have any last thoughts, yes, again, it is our live event that you can attend from the comfort of your own home Thursday the 19th at 8 p.m. Eastern in just a few days here with Naresh and the builder who you heard on last week's show, co-hosting a live webinar for Central Florida, so inland, new build income property. It's free, you're invited, and the benefit of you attending live is that you can have any of your questions answered in real time. You're going to learn more about the Central Florida market and more about the home building process. And you are going to be able to see available new build property, real addresses with some of these pretty grand incentives that we've talked about. Again, grewebinars.com. Any last thoughts, Naresh?
I get a lot of questions about, is right now the time to buy? Should I buy later? What's going to happen with real estate? And I know the number one question or the number one caution our followers are going to have is right now the time? Is March or April the time? And I say, look, with real estate, I already gave you the figure that you take any 20-year time period, any 30-year time period, and that's our time horizon here at GRE. Again, we're not trying to buy Bitcoin here and flip it, 2 days later. We're looking to buy and hold for, I don't want to say forever, but I know my time horizon in general is the full 30-year term, at least for my properties. And some people, want 10 or 15 years. That's fine too, but that's the time horizon. It is not 1 year, 2 years. We're not flipping new construction properties here in Central Florida. We are looking to buy and hold over the long haul, get some very good, high quality tenants in there in these new construction properties so that you, the GRE follower and the investor, can collect your monthly cash flow, as well as over that 20-year period or that 30-year period, take part in appreciation as well. We've also talked extensively, Keith, in previous episodes about interest rate cuts that the Federal Reserve is going to be doing. And just know this, there's a reason why the builder is offering these incentives where you can get the rates so low. Your mortgage rate can be so low, and it's going to take at least a year, even if the Fed goes to zero. I mean, it's going to take mortgage rates a very long time to reach that point of getting such low interest rates that you just laid out. So that even makes it more enticing. Like, hey, I basically have a head start on the Federal Reserve because I follow the Fed pretty closely. We don't need to get into those details, but it's looking heavily like they are going to start cutting again later this year, this summer. So it's looking like they're going to do that. But again, now you can have a head start because when the Fed starts doing that and when the mortgage rates fall, then everybody's going to jump in. And what's going to happen to the home values once everybody jumps in? Well, they're going to go up. You want to jump in when everybody is not jumping in and when you can get an amazing deal on these interest rates thanks to the builder buying down your interest rate. So this is a GRE special. You can't get these deals. I challenge our followers to go on the internet and try to find better incentives or deals than what you're going to see on this webinar, on this online live special event. So grewebinars.com. You can join me as well as our special guest. He heads up the builder. His name is Jim. He's going to be on with me. And please join us at grewebinars.com. Sign up for this free and live online special event.
Oh, these are some great points. There's a lot of anticipation for Thursday. Naresh, we'll see you then.
Thanks, Keith.
Oh, yeah, a first-person account on Florida life and opportunity from our own Naresh. Nationally, the build-to-rent model, that has been a real success, building single-family rentals with the intent that they are rentals from day one. Over 321,000 homes have been built specifically as rentals this way since 2012, and more than 3/4 of those in just the last 5 years. So the build-to-rent trend is picking up steam. About 1/3 of Americans rent their home, and although the word rental, for some people that still conjures up visions of high-rises packed with apartments, but a growing number of today's rentals are these freestanding single-family homes and duplexes like we're talking about today, nestled in suburban communities with top-notch schools, and that's why a growing number of mom-and-pop investors have hopped on the build-to-rent bandwagon. They take less maintenance, it attracts quality tenants who stay longer, and the rentals have changed, but so have the renters. 20 years ago, it felt like tenants had to rent, like they had no choice. Today, you've got more and more tenants that choose to rent. Many of them make $100K to $125K or more. Today, rentals are cheaper than owning for those people, and they're less of a headache. A lot of them don't want to fix things, and you as the owner don't want to either. That's why new build is attractive. Then, I just sent that great map to our newsletter subscribers about which states saw the most population gain from 2020 to today. The South had more population growth than every other U.S. region combined, which is jaw-dropping. And within the South, the state with the most population growth since 2020 is Florida, with an 8.9% population gain in that span, narrowly beating out Texas and South Carolina, by the way. Even if it weren't for the attractive builder interest rate near 4%, these Sunshine State deals could still make sense. New build single-family rentals from the 270s, new build duplexes, $395 to $420K, low insurance rates, positive cash flow, a builder warranty, and it's really even better than that. These properties are centered on Ocala, Florida, which received national recognition as the fastest growing city for the second year in a row. That's according to a U-Haul report. And Florida is the epitome of investor friendly. Florida is the first state to enact a law allowing law enforcement to immediately remove squatters. It distinguishes them from legal tenants. You might come to the webinar event perhaps thinking about $80K or $500K that you want to allocate toward property, or maybe nothing and you just want to learn. At the event, you will evaluate realistic opportunities, learn how property management is handled, and understand how today's inventory fits into your disciplined long-term strategy. That all takes place on Thursday, the 19th at 8 p.m. Eastern. It's our biggest event of the year, and it is called Why Central Florida is the Year's Most Compelling Housing Market. One last time for Thursday, it is grewebinars.com. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.